So please do join me in welcoming Rebecca, Matthew, Pav, Charlotte, Mike and Justin.
Thank you, Steph. We're looking forward to a very interesting discussion. We're going to look at the structuring and regulatory approaches, capital flow, which we've heard from the fund managers, so important, and then the frameworks and Guernsey's ecosystem in that space. So we'll go straight into it. So Matt, we've heard from some great fund managers about how they're using Guernsey. What do you think that Guernsey has on how we can support the structuring and what's available there?
Well, I think the answer to that was given at the end of the last presentation by Anna and Ruth, and how we do it is really by finding solutions and just getting it done and making the process as simple and as easy as possible. And that applies, I'd like to think, for any fund manager, not just sustainable fund structuring. And how do we do that? Well, I think it's from a Guernsey lawyer perspective, it's what we as Guernsey lawyers know and who we know. So what does that mean? Well, first of all, familiarity with the types of legal structures that are suitable for your funds. And very often it's familiarity with onshore firms, because we work hand in glove with onshore firms to find the right structure for your funds. So that you simply get it right from the start. They're able, of course, to advise on the broader tax and legal and regulatory implications beyond Guernsey to make the process as smooth and the fundraise as efficient as possible. And also our familiarity with the Guernsey legal regulatory structure. So we're using this word fund, but very often a Guernsey lawyer will be able to help you work out whether or not your vehicle is even a fund and is caught by Guernsey fund regulation, or if indeed it sits entirely outside of that. Of course, then that simplifies the process even further. And if it is caught by our fund regulation, which fund regulation would be best for you, for the types of assets that you're acquiring, for the types, particularly the types of investors you're acquiring. We're also very familiar and able to advise you on a start to finish basis, so we can give you clear roadmaps, what's going to be needed, by whom, by when, what the roadblocks are likely to be in the process, so you will know from day one what the real pinch points are, again just so that you can front load all the hard work and get it done. And I said who we know. I've obviously referred to onshore counsel, but Guernsey lawyers will have really close links, and it's something that we all work very, very hard on, is maintaining links with not just onshore counsel, but our administrators. As much, I always say to prospective clients, as much as we as lawyers like to think we're terribly important, the reality is we're not. Your administrator is your key relationship.
We think you're important.
Well, thank you. But once we're like shipbuilders, once that ship is off and sailing, we really don't have much to do with it day to day. Your administrator is your key, and we work closely with administrators to find the right ones for you. Same for auditors, same for custodians, same for NEDs. So a Guernsey lawyer will provide you with sort of an overall advice as to the best ways and means to structure your fund, and all the right and the best personnel to do that with. And then finally, the regulator. We are very fortunate. We have a highly responsive regulator, and I can give some live examples that happened in the last few days for me in the context of, it was a Latin American forestry fund, and they wanted to put in place a cellular vehicle, which I think we'll hear about in a minute, which is one of Guernsey's legal vehicles, which are very handy for efficient fund establishment. Typically, the Guernsey Green Fund, which is a designation I think we're going to come on and talk about, applies to the whole fund. And somebody said, well, I've got a sort of white labelled structure with multi-manager cells, and can I just have one cell as a Guernsey Green Fund? I've never been asked that before. I don't know if any of the other Guernsey lawyers in the room have been asked that, but I phoned up the GFSC, because we have direct lines of communication, and I asked them, and the next day I had an answer. And that is typically how we interact with our regulator. It's incredibly responsive. So we can find you a solution really quickly, and that's really, in summary, how we as Guernsey lawyers will help you with your funds.
That flexibility is actually really important, and the fact that you can talk to the regulator. Also at the heart of sustainability is to be able to have that flexibility, but also innovation as well. And Mike, you've been working a lot in the insurance industry with innovation and how that can be applied. What have you seen as enablers for sustainability in your sector?
Well, I'd say to start with, I think Guernsey has a history for innovation, sort of full stop, not just in the world of insurance or anything. It's probably sort of, you know, its economy has changed many times over the centuries, right? We recently in Guernsey celebrated 100 years of a captive insurance company. And an article went out in one of the leading insurance magazines, which had a timeline of game changers across the insurance industry. And I was able to look at it and go, well, actually, that was done in Guernsey, that was done in Guernsey, that was done in Guernsey. And that's something that's really good for me, because in my role, I'm traveling around the world, I'm selling Guernsey as a domicile and other domiciles to people. And quite often, being able to say that you did that and it was done in Guernsey is important. Now, the first structure kind of that springs to mind is the PCC, or Protected Cell Company. That was started in 1997 in Guernsey. And we were proud at Aon, we launched the first one that was called White Rock. If anyone's been to Guernsey, it is named after the cafe at the harbour. If anyone's been lucky enough to go there for breakfast on their way to the island or onto one of our sort of sister islands. The next thing that happened, we had the ICC framework that was brought out in 2006. Now, the protected cell is one legal entity with individual sort of segregated accounts within it. An incorporated cell company is very similar. However, each individual cell is a legal entity in its own right. So it has its own incorporation documents, it has its own license, it has its own memorandum and articles, it has all of that sort of thing. And it has the ability to put people on the board. And that's something that we're seeing people are liking to use increasingly in some of these sustainable and humanitarian transactions. Because it takes a lot of trust on someone to give money. It's been raised from donors to you to look after when you're ultimately supporting someone like the Red Cross or the UN or something like that. So having these structures in place, having the robust regulation is really, really important when we're doing these transactions. Another thing I'd like to mention as well is the Guernsey Insurance Association. They brought out an ESG framework, and that was based upon the UN SDGs. And I think the first one to achieve that was actually the volcano bond for the Red Cross that we did. And having that framework which aligned with the SDGs gave investors confidence that this is something that meets your sort of green agenda from an investment perspective. And then Ties, who of course are sponsoring here today with their green segment, we were able to list those bonds on that green segment. Again, that was something that was important. And then also, again, talking about Ties and innovation, we were able to get blockchain authorized as a recognized clearing system. And that saved a lot of money when it came to transacting on one of these bonds, because in the world of sustainable finance, it's really important that the structures are efficient from a cost perspective. Every penny that you're spending somewhere else is a penny less that you can invest in something that's providing maximum impact. So I think from our side, a lot of innovation has happened in Guernsey. Please come and see us, every one of us up on here if you've got any good ideas, because we're always happy to help on these sort of things and engage with the regulator and have those chats with the local providers and pull something together that works.
Great. So it's not just us from Guernsey saying how great we are. We did actually have a report come out this year from Pawel about Guernsey's prevalence for venture capital funds and how it's one of the twice as many funds, I'm going to have to read this, twice as many funds raised in Guernsey during 2022-2023 compared to the next most popular jurisdiction. So, Charlotte, as you're in fund administration, What are you seeing in the VC side, and how is sustainability connected to that?
Yeah, so I think the Proskauer report was an interesting one. So it came out earlier this year, and it focused on European-focused venture capitalists. And they looked at about, I think, 38 funds, and they found that the Channel Islands remain a prevalent jurisdiction with about 39%. So that was a really interesting report for us. And I think they actually then looked what matters to venture capital fund managers, and they said familiarity is really important. The investors need to know the jurisdictions. The fund managers need to feel comfortable in the jurisdiction of their choice. The next is cost. Obviously, cost is a major factor, but also for first-time fund managers, it's really important. So that was another. And then the last is actually the administrative burden of some jurisdictions versus others, and they found that Guernsey was an accessible jurisdiction and very efficient in terms of fund administration. So, but I do have more to add to that. So I would also say like speed is a big thing, and also proactive service providers, people going the extra mile, people responding to emails. So I might just delve into those in a bit more detail. So familiarity, first of all. I mean, we've been doing this for over 50 years now, so we understand venture capital, we understand the life cycle of a fund. Structuring, I mean, Matt's touched on it a little bit there, and so I think in terms of structuring, we've got the GPLP, very well known. You've also got the PCC. So just to add on the PCC side of things, we're actually seeing it become really popular at the moment, especially over the last couple of years. And what's interesting about the PCC is flexibility. So we've seen different strategies per cell, because it's an umbrella, so per cell. Also different investor groups per cell. So if you were looking at it from a sustainability point of view, you could actually have different types of sustainable assets in different cells. If you could have that regulated if it's multi-investor, multi-investment, but also if you're doing building track record, you can do deal by deal, so you could have single kind of investment and have it unregulated, which for first-time fund managers is really useful from like a cost perspective, but also speed to set up. And then I'll just briefly touch on the regulation. So there's a couple routes that are really popular. So you've got the registered fund, not that many limitations with the registered fund. There's no restrictions on kind of number of investors, number of investments, strategy. You do need a full prospectus though. We then had the private investment fund that came out, and actually the private investment fund has been very popular with venture capital. The reason being is a little bit lighter touch because it's meant to, the fund managers are supposed to have a closer relationship with the kind of investors. So you don't need a full prospectus. You can actually get away with just a term sheet, a disclosure document, has all the risks in there and full disclosure about the investment objectives. But also you don't need share capital, so you're saving £10,000 currency equivalent. So the PIF has been, and anything can be a PIF, so distressed debt, private equity, venture capital, real estate. It doesn't matter. It's just a regulatory route. And that is a one business day turnaround. And actually I know everybody says one business day turnaround, that's so fast. I have actually seen one business day turnarounds. And then actually just to touch on with a sustainable view, we had the Green Fund in 2018. So it's designation, and the Green Fund is actually a world's first. So it is the world's first regulated green regime. So that's got over 5 billion now of AUM there. And then in 2022, the regulator brought out the Natural Capital Fund. And the Natural Capital Fund focuses on protecting natural ecosystems. And we might delve into that a bit more later. And then just to round up, I actually just will touch on the EU passport and MPPR. So that is how, obviously Guernsey is not in the EU, so it's how we access EU investors. So yes, if you're in the EU, you can have the passport, you can market to any EU jurisdiction to investors there. In Guernsey, we use the national private placement regime, so you have to apply to market into each jurisdiction. Now, what is interesting is, in my experience, marketing is either not done, or if it is done, it's actually only to 1, 2, maybe 3 jurisdictions. Fund managers often come in and say, I want to market to 10 jurisdictions, but in reality, they end up raising in only kind of 1, 2, or 3. So when you look at the cost of that, it's a simple application your onshore council can do to the local jurisdiction. And then if you raise funds, then you do periodic reporting to those regulators. We have expert providers who can do that, and actually the cost is a fraction of potentially what it could be to have the EU passport, because no third party AFM, no depository, no custodian. So I think the key message is it's just really important for fund managers and venture capital to actually, when they're setting up their fund, really think about where you will be marketing, where you want your investors to come from, but also look at the life of your fund, 12 years, 10 plus 2. What is the cost of your selected jurisdiction? And I think that's really important.
That's great. Thanks, Charlotte. So we've had the regulation, we've had the innovation, we've had the speed to market. The capital flow is obviously really important with sustainability. And Justin, how is Guernsey being used specifically for capital flow into particular projects?
Yeah, and I think just to add to my fellow panelists, I think you've got fund administrators, you've got fund lawyers, you've got the regulator, you've got innovation, but there's also on island bespoke advisory when it comes to specialist impact and sustainability capabilities. So I think what you're looking at is really a sort of full suite of solutions on the island. We at Innovest are a specialist impact and sustainable investment advisor for both private markets fund managers and also private asset allocators, so both the supply and the demand, and that's roughly around $3.5 billion of capital committed to impact and sustainability fund strategies. And I think what we're seeing is naturally the island is a real conduit for sustainable and impact capital across a range of different structures that have been talked about by fellow panelists, but also across not only funds, but private asset owners and also corporates. So maybe just to give a sense of what that looks like and some examples. So on the fund side, right now in Guernsey, a few examples would be an energy infrastructure fund focusing on off-grid solar infrastructure in sub-Saharan Africa, a climate technology fund focused on the energy transition in developing markets, and a circular economy fund focusing on sustainable lifestyles, including clothing and food. So these are just some very specific examples of private market, both private equity, private debt, and VC investing through Guernsey established structures. On the private wealth side, looking at family offices, foundations, and charitable trusts that are structured in Guernsey, and in some cases family offices that are where principals are domiciled in Guernsey as well, having very specific and tailored sustainability and impact strategies. A good example would be a Middle East-based structure, a foundation structure that's committed 50 million to both a philanthropic and impact investment strategy for the region, the Middle East region, ultimately focusing on job creation and economic empowerment for women across the Middle East region. And that's all structured through Guernsey, both philanthropic and impact investment solutions. And then on the corporate side, it was touched on, holding company structures, SPV structures, and a good example that we've been involved with is an African farms business producing export grade farm produce and using a Guernsey structure basically to facilitate international investment into that farm structure, but also offtake agreements, including with UK supermarkets. So your East African blueberries are being sold in Waitrose through a Guernsey structure.
There you go. Pav, you've got the family office background, which Justin has touched on, and how capital flow is coming through on a philanthropic side, but also on an investment side as well. What type of asset classes are family office mostly involved in?
It's as wide as it is kind of long. I recently joined Ocorian as private client director, but for the 8 years prior to that, I worked with a Middle Eastern family office. and it was interesting to listen to our panelists, first of all, because they were talking about kind of the profit and then the return, whereas what I was seeing from a family office perspective is you've got the second generations coming through, and they're much more educated about what's going on with sustainable investing, whether it be environmental, social, and so and also that education of that has matured as well, and a lot of the second generations are privileged enough to have a pot where they can do some good, and they're no longer fully concerned about the return they're getting, but it's more about their values and their tastes in what they're interested in. The thing that is offered kind of institutionally is great, but when you've got a smaller pocket, they're more bespoke. And the family office that I was working for in particular, the first generation wanted to assist in the displaced kind of society from where the community they came from. So when it was in Syria, so when Syria comes back up and running, whenever that may be, instead of having to start from scratch, the displaced communities can come back and kind of try and hit the ground running. And we did that on a foundation basis, and that was, yes, philanthropic, but to a degree there was some tax offsets there as well. Interestingly, the next generation, the sons, they've set up private equity funds. Their asset classes are more in renewable energies, specifically disruptive technology, in the solar industry, more monitoring in respect of how to get this reusable, sustainable energy onto the grids, and how aged infrastructure can be utilised or improved to do that at reduced cost, and bringing this energy in and reducing the requirement for not environmentally friendly methods of getting electricity onto the grid. And then we've got the younger parts of the family who are looking at personal interests. So, for example, we had looking at, just in Lebanon, the amount of plastic that is wasted. And we were talking about carbon offset and carbon credits, and they were looking at ways of doing something very similar with collecting all of these plastics, maybe finding some way to recycle them, and this is very much in its infancy, and have almost like a plastic credit trading platform where the likes of, I don't know, for example, Pepsi, who can take these plastic credits and offset them against the plastics that they're bringing in through their bottle processing. The beauty that we've got is that we have experts like Justin, and we have all kind of the infrastructure providers who, if we have these ideas, they can help us facilitate that and bespoke. And Justin, actually, in the family office that I've had been working with until recently, was very much involved in finding solutions, and actually is a fantastic individual to know. I'm not just trying to, advertise him, but we have great experts like Justin and my other panelists here on island, and we also have a big network of non-executive directors who have experience in the space as well, who can add a lot of experience and knowledge around a lot of the products that are being offered.
It's interesting that you say with the family, it sounds like the patriarch has set the tone for the rest of the family office.
Well, he makes money in oil and gas, so I'm not sure.
Feels he has to give back to society,
Yeah.
and actually all the generations are following in their own way and making their own impact in that sort of almost a patient capital type approach as well. So no, that's really interesting. So I suppose on to you, Mike, just about, we've heard about that patient capital and how you can actually make a huge impact measured by Justin's firm through Innovest. You were instrumental in the world's first humanitarian catastrophe bond. Can you tell us a bit more about that and your experience of the capital flow?
Yeah, I'll talk a bit about that, and also about a couple of other transactions that we've been involved in recently. Firstly, if I could step back to why humanitarian organisations are looking at insurance and cat bond solutions. Humanitarian organisations, they're not like us. They can't go to the bank, right? They can't take some extra money out, or that what they can deploy is basically what they raise in donations from the likes of us, putting your pound coin out in the little jar outside the shop, or whatever it is. But what you have to realise then is that when that pound goes into the jar, maybe 20 pence of that goes to pay the running costs of the Red Cross, it goes to pay for their rent, it goes to pay for all of those sort of things. So you're not really seeing the full value of that money. Increasingly, when we're looking at when we're speaking to donors, governments, things like that sort of thing, one of the key things they're looking for is value for money in their donation. There's a group called the Centre for Disaster Protection, which is a CDP that we do a lot of work with, and they advise humanitarian organisations and other people about the best way to produce their donor models, basically. And so what we are doing when we look at these things is creating value for money by using the donations to pay an insurance premium. And that insurance premium there, so for your £1 donation, instead of 70 pence or 75 pence going to the Red Cross, you're actually accessing, say, £5 or whatever it may be, because of that leverage effect by using insurance. Now, that does come with a challenge. You can imagine going to the Red Cross and saying, we'll charge you a premium of 200,000 for this. Most of the people in the room will want the money now to deploy it to wherever the problem is in the world. So there is an education period that we're having to go through to get people used to this and understanding the long-term value in what we're doing. The cat bond we did was parametric in nature. It was based upon 10 named volcanoes around the world. The payout, the insurance payout, was based upon the plume height of the volcano and the wind direction. So if the ash fell over agricultural land, if it fell over habitable land, so on and so forth, the payout would be bigger. The bond itself was only $3 million, so it wasn't a big transaction, but it's very much like proof of concept. What gets in the way of these transactions being bigger is the amount of donor funds, because the donor funds have to pay the costs, they have to pay the premium. And so on the cat bond we did, the return was 5% on that bond, and it's principal at risk, right? So you have to try and get the balance right there to bring in the investors. The investors on that were Schroders, Plenum, and a company called Solidum. They're all friendly investors, people we knew well, right? So it wasn't particularly a hard sell for us to do that and to put that in place. That transaction has now closed, no claims have been paid, and we've had loads of calls from investors saying, are you doing it again? Is it renewing? Is there any more of this that we can go into? So we're hoping to see more of that. Other things we're doing, we've just done a big transaction with the IFRC, the Red Cross. That was a transaction with Hiscox, so it wasn't investors. In this case, it provided access to 15.5 million additional Swiss francs of capacity in the event of a disaster somewhere in the world. That triggered this year. We've paid claims, and those claims have saved, I think it's estimated, an additional 1.5 million people around the world on the back of those payouts that we've made.
Great.
We're also working on other things. We're working with the EBRD on projects. We're working with the UN and the SMI on other projects, and they're all there to really use insurance to create leverage and therefore to bring more capital and more money in there to deploy in the event of a humanitarian disaster.
Great. So you're making a real impact with what you're working on and how you're using Guernsey for that. That's great to hear.
And I would say as well that the fact that Guernsey did it first in the tiny little 3 million cat bond has meant that that's where everyone's looking for transaction number 2, 3, 4, and 5. So doing something first is pretty important, right? Because at least in the world of insurance, everyone follows. So, and that's why we're continuing to have these conversations with people. I think we've just, either today or tomorrow, we'll be closing a similar transaction with someone called the Start Network as well. So there's a lot of stuff going on in this place and all through Guernsey.
Great, good to hear. We heard before on our other panel how important frameworks and reporting are. It's probably not quite as exciting as the capital flow in the projects, but it's something that's really important, particularly for investors as well. Justin, what do you see as the expectations that investors have on what they're looking for in their reporting and their measurements?
Yeah, I mean, I think specifically to private markets impact and sustainable funds that we work with, I think what you're seeing is an LP base that's increasingly sophisticated and nuanced in terms of their expectations of a GP. And if a manager is putting out a strategy to the market around a clear non-financial return to investors alongside a commercial return, and that non-financial return being a climate impact or a human development impact around education or job creation, that non-financial impact can't just sit there as a statement of intent without any substance or backing or evidence that the manager will seek to basically prove that over the course of the investment. Because ultimately, LPs are coming into a deal with a dual lens that they are committing to a fund based on a commercial return and this set of non-financial variables as well. So I think an LP is coming in with a set of expectations around a clear strategy about how the fund manager will achieve sustainable or impact objectives of their investment strategy. They will need to see clear evidence of how the impact or sustainability strategy is embedded in the life cycle of the fund, including, for example, the screening and due diligence process and the portfolio selection process. It can't just be done on commercial criteria. How a manager is aligned with international standards and frameworks. And that includes obviously regulatory standards and frameworks like SFDR in the EU or SDR here in the UK, or voluntary standards and principles, for example, the operating principles for impact management. It's a kind of sign, a benchmark of quality. Does a manager, are they aligned with their peers? Do they have the same set of standards and principles in place? Then I think the manager is also looking around internal capacity. So what are the credentials of the manager when it comes to measuring and reporting these non-financial returns? So do they have sufficient competency across ESG, sustainability and impact with dedicated staff functions and authorities? That investment decision making, again, looking at a governance flow, how is impact and sustainability considered at the level of the investment committee? How does that flow up to the board? And ultimately, an investor, a sophisticated investor, is looking to say at a board decision, was impact or sustainability a material consideration in the ultimate investment decision? And then I think that that sort of the post-investment period, so the active management period of a fund, how does a manager approach impact measurement or sustainability measurement and reporting? What are the metrics and KPIs that they've identified? What is their ability to actually extract that data from portfolio companies? What do they do with that data? Are they analyzing it? Are they inferring evidence from that data that aligns with their stated objectives right at the start in the PPM, for example, or the prospectus? And then what is their commitment to transparency? So do they open themselves up for external scrutiny? So, for example, through third-party verification or assurance, and some of these standards actually require that. And I think the fact that they do that is a sign of transparency. And yeah, I'd say those are some examples of where investor expectations are at. Mm-hmm. And obviously the counter or the flip side of that is if a fund manager cannot demonstrate those core policies, processes, and people, they may not get investment in the first place. There is a whole body of work now building around dedicated sustainability and impact due diligence processes, impact DDQs. A manager won't pass those gates unless they have these in place. And if they can't provide quality, disaggregated, accurate data that evidences the impact of their stated intent, that is a reputational risk, and they certainly won't get investors in their fund too. So these are, I think the main point is that these are perhaps nice to haves in the past. If you're now launching a sustainable impact fund, they are need to haves, and these are material issues that if you don't get right, there's a huge opportunity if you get it right, but it's a huge risk if you get it wrong.
Yeah, they've absolutely got to be built into the governance framework, and the board needs to be responsible for making sure that everything works properly on information flow through to the board and then out to the investors as well. Pav, you've sat on boards which have this impact element. What do you see as the most important part that the board has been responsible for in this way?
In addition to what Justin's just said, I think
Okay,
he's
just
just
that.
answered my question. Yeah, what he said. I think from a board position, with this becoming so much more front and centre, the board had a responsibility. This has just added another layer of responsibility, and then to have the ability to get a meaningful impact report which will validate what you're trying to achieve from a board perspective, which matches the mandate that the investment manager has had, and to ensure that the investment manager continues to follow all the way through the lifespan of the fund is very important. And we do have the expertise on Guernsey to be able to provide that quality of reporting, which, in addition to what you normally see in a board pack, is so important.
And it's important at that structuring stage as well to be able to determine what the right reporting framework is. Matt, how do you assist clients with that?
Well, in terms of the framework, the decisions that any sustainable fund will need to take, there are two. The first one is, as Charlotte alluded to earlier, is what is the regulatory framework within which my fund is going to sit. So that's essentially a choice between a private fund, which is limited in terms of number and nature of investor, or a more sort of full-fat fund that's more widely available. It's important to note that Guernsey fund regulation is completely asset agnostic. But then you come to the second choice in terms of the framework, and that's the choice for a sustainable fund between the Guernsey Green Fund and the Natural Capital Fund that Charlotte also mentioned before. Now, of course, going back to what I said at the start, we would be working with you to make sure that both of those considerations are taken into account at the very start. Theoretically, there is a chronological order where you get your fund regulated and then you ask for one of these designations as a Guernsey Green Fund or a Natural Capital. But in reality, we'd all be working for it from day one. So what are these two designations? Well, any fund, any Guernsey fund, open-ended, closed-ended, of whatever type, can ask if it's eligible to be designated as a green fund or a natural capital. Guernsey Green Fund was the original. That's much more focused on the objectives of mitigating environmental damage and climate change, whereas the Natural Capital Fund is more focused in seeing nature as a capital asset. So it has a much broader a scope of eligible investments, and they must all satisfy certain investment criteria. You should also note that Guernsey has not created additional sets of rules that have to be complied on. These are all international standards. We are not creating and writing our own rules as to what constitutes a green fund or not. So they pick up common principles for climate mitigation finance, EU's taxonomy for sustainable activities. I can never remember these, so I wrote them down. United Nations Convention for the Natural Capital, the UN Convention on Biological Diversity, UN's Sustainable Development Goals, and the EU's taxonomy for sustainable activities, environmental objectives. So we're not making up our own rules. These are rules which a sustainable fund manager would be familiar with, so they can know in advance what they need to do, how they need to do it. The investments are monitored, and the administrator or external experts would be able to confirm that you meet these particular rules. But these are decisions, again, going back to what I said at the very start, these will be taken at the start of the process, and we and all of the other service providers involved will work with you to make sure that when that submission goes in, the GFSC is already aware of it, and you are almost certainly going to satisfy those criteria to get your designation. Once you're designated, it appears on the GFSC's website, and you are entitled to label your fund a Guernsey Green Fund or a Natural Capital Fund using the logos. And so it's a stamp of quality, and it's has marketing benefits.
Great. So we've heard the ecosystem is rather vast on the different areas that we have. We've got private office, we've got administration, we've got insurance, we've got advisors, we've got legal teams as well. Charlotte, did you have anything else that you wanted to add into how this ecosystem works together?
I would just probably say two quick things. I think the first is that Guernsey and its regulator, the GFC, are pushing for change. We are trying to make a difference. We've discussed the Green Fund and the Natural Capital Fund. The International Stock Exchange have their sustainable platform. But I think it's also in the mindset of Guernsey as a jurisdiction and our service providers locally. So that's one thing. And then what I'd say is again about the regulator actually, is they are aiming to be simple, sensible, transparent. And everything I've said today is the same: simple, sensible, transparent. And I'd say just a key example is look at the Green Fund rules. They're 30 pages long. You can have a cup of tea and you've read it by the time you finished your tea. So I think that's just quite big when you look at, and I'll give an example, it's not a criticism. SDR is 212 pages long. So I think, we want it, green needs to be accessible. People need to understand it when they pick it up. And I think that's what the GFC are trying to do.
That's great. Well, thank you very much.